Is winter coming like Michael Burry thinks? Well, a lot of investors are skeptical. They're looking at favorable inflation data, which ticked down in the most recent month in July. Previously estimated 8.7%, which is down from over 9%, actually came in at 8.5, below expectations. Core inflation also came in lower, showing several months of decelerating inflation. This could be quite favorable, suggesting, hey, could we have a potential soft landing? And that sort of buy the rumor, sell the news attitude is what has driven this, I'd argue, a significant rally in risk assets. You look at, let's say, the NASDAQ, QQQ is the ticker, that's up over 20% from its lows in June. People are putting on their party hats, asking themselves, is this the beginning of a broader bull market? And Michael Burry is saying, no, not a bull market. No, this is just baloney. And he's saying the NASDAQ, a bull market because it's up 20% off its lows. Who makes this stuff up? After 2000, the NASDAQ did that 7 times as it fell 78% to its 2002 low. This is a really important point for investors to consider, which is that when you're facing the significant risk of a broad and deep bear market, which I'd argue we're facing now, you will have periods of rip rally, bear market rallies that just rip your face off when you go, oh man, this is great, and you want to chase it. That's what a lot of folks are thinking. And the reality is, no, in these big bear market rallies, you can see upside 20, 30, 40, 50%, but still you're still facing this huge downturn of, let's say the bear market goes down 40, 50, 60%. We arguably have not seen the lows of the cycle. That's at least, the take that Michael Burry's saying, look, this is nowhere near the lows. This is just a bear market rally. Part of the reason why, and folks might say, well, he's just a perma bear. This is his attitude. Well, part of the reason why he's saying, well, what's actually driving the economy right now? Around 70% of US GDP is driven by consumer behaviors. And you can see the consumer is really just staying alive based on surging consumer credit, where you see effectively record borrowings occur in the last few months on revolving and non-revolving credit, tens of billions of dollars. Some of the fastest rate in borrowing that you've seen, literally in decades. So what's going on here? Once again, Michael Burry sharing his take, saying, look, net consumer credit balances are rising at record rates as consumers choose violence rather than cut back on spending in the face of inflation. So he's saying consumers would rather borrow rather than cut back on spending in the face of inflation, which they have to do. Remember the savings glut problem? No more. COVID helicopter cash taught people to spend again, and it's addictive. So people are addicted to spending, thinking they'll always get some sort of, handout or savior. And he's saying winter is coming, or winter's coming. And I think it's important to draw a potential analogy here, because this is arguably in Michael Burry's wheelhouse, where he says, wait a second, let's look at consumer behavior, and then let's look at what potentially is driving their behavior that can be quite different from history. And you're saying in the last few months, consumer debt has jumped dramatically in terms of, consumer borrowing. And he's saying, well, let's look at how Michael Burry previously made a ton of money on it. When he was looking at the great financial crisis, he saw once again mortgage debt going parabolic relative to consumer income. And he said, wait a second, this is what's driving the elevated home prices. And this is why he thought, well, wait a second, this debt is going to need to get repaid. But he saw that there were all these adjustable rate mortgages. So once again, this is the reason why he's saying they're choosing violence rather than cut back. He's saying this debt that consumers are borrowing now, let's say credit card debt, that's going to need to get repaid very quickly. Unlike these mortgage debts, that the adjustable rate mortgage, the ninja loans that may have had sort of a trial period of a couple of months. Well, this consumer debt, this is going to be, you're going to need to deal with it in the upcoming months versus the years that you had, with the great financial crisis. So I think he's looking at this saying, yeah, this is a potential problem that you need to deal with, right away. Now, look, he further comments on this bear market rally saying, yeah, the NASDAQ's now up 23% off its lows. Congratulations. We now have the average bear market rally across 26 bear market rallies from 1929 through 1932 and 2000 through 2002. The average is 23%. After 2000, there were two 40% plus bear market rallies and one 50% rally before the market bottom. So this gets back to our prior point that in these mega bear market drawdowns, you should expect to see these rip rallying, bear market, rip your face off rallies, because it's part of the conditions where you go, oh, it can't be that bad. And I think this is the reason why it's so important, at least for me personally, instead of getting caught up, oh, is it a bear market rally? Is it a bull market? I just focus on, hey, what's the valuation of this company and do I really like it? Regardless of if there's a recession, if there's inflation, is this a deeply compelling valuation where I can pencil out, let's say 200, 300% upside? If I can, then I say it's okay. I can hold back and wait for more compelling prices because arguably I think over a full market cycle, you do eventually get those compelling prices. So the question is, where does the market go from here? Is Michael Burry right about all this? First, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. And in full disclosure, this is not financial advice. And so I think the multi-trillion-dollar question comes down to inflation. How does that play out from here? I think part of the reason why you see this major rally in risk assets is folks are saying, yeah, the expectations of future inflation. Here's various different surveys of consumer expectations of future inflation, whether or not it's 1 year out or 5 years out, is that inflation looks like it's tamed based on consumer expectations. And the reason why this is so important is they're effectively saying, yeah, 5 years from now, folks are saying, yeah, this is only going to be around 2% inflation. This is mission accomplished. 3 years out, closer to 3%. That is pretty close to mission accomplished. The reason why this is so important is if people expect inflation to be 4, 5, 6% in the years ahead, that is a psychological problem, because you would reach this point where more people are going to say, hey, I expect inflation to be higher in the future. I expect raises. I expect prices to go up, every period, every year. And so that sort of starts, getting filtered into the economy where prices do have to go higher. So if everyone starts raising their rates because of that expectation, you sort of get this momentum going. And that's the real problem that the Fed is concerned about. So the Fed is happy to see, yeah, inflation expectations, for this next year, it's still cooling off, still around 6%. But really looking 3 years out, 5 years out, this is under control. Therefore, the odds that the Fed has to continue slamming on the brakes, doing these 0.75 percentage point, rate hikes that really do put pressure on the economy. This is saying, hey, this might be under control. They won't have to do it, in which case you will not have a deep recession because the Federal Reserve has slammed on the brakes. That's the sort of favorable, outlook, because they're saying inflation is under control, potentially. I'd argue the devil's advocate perspective is that you need to look at the individual components of inflation and say, yes, there has been some commodity relief in the last few months, but some are saying, yeah, but the supply problems, the supply shortages with some of these key commodities, oil, really hasn't been solved. And so, for example, Goldman Sachs is talking about how by year end, you might be looking at oil prices of $120, $130 per barrel, much higher from here, from around $90 per barrel. In which case, if you have some of these commodities because of supply shortages, because the investments haven't occurred to say, hey, we need to beef up our supply relative to, let's say, a humming hot economy. If you have something like that, or just a medium economy, not even necessarily hot, if you don't have, let's say, the supply resources that you need, the supply investments that you need to get oil and various different commodities to where they should be, you could get much, much higher commodity prices, in which case that goes back into inflation, because you look at something like oil and that goes into everything in the economy. And so this is, I'd argue, the key counter thesis to, inflation expectations are coming down, but wait a second, what if the average consumer isn't getting the price of oil right, and in the next 6 months oil goes parabolic, goes 40-50% higher from where it is here, and that could create real problems for inflation and then broadly the economy as well. Now, the question about a soft landing, I think it's really important to consider base rates, and that's arguably what several different economists have called out. Larry Summers, former Treasury Secretary, calling out how soft landings represent a kind of triumph of hope over experience. And that's the reason why it's so important to consider base rates. And I talk about, that I talk about base rates, for my own investing, but it's also discussed extensively in this book, Super Forecasting, which I highly recommend. The concept is that, look, you should look at what's historically happened with these circumstances. And so when you've had historically inflation that's really high and unemployment really low, like we are today, the odds that you're able to get an economic outcome where inflation doesn't, where inflation comes under control, but unemployment doesn't go up significantly, that's really improbable. And saying historically that, you're really talking about the odds of a non-recession, non-huge impact on the economy of, based on which scenario you're looking at, you're probably talking somewhere between 10-25%. So it's based on historical, effectively the data suggesting lower probability outcome of a favorable outcome. And that's why it's so important to say what has happened historically and could it be favorable. So it is possible you do get this soft landing. This is my own personal take. You do get this soft landing, but do you really want to bet on an outcome that's, let's say, 10% chance of happening or 15% chance happening? Or do you want to say, hey, we're more likely to go through a situation where you have these sort of bumps in inflation. 1 month does not necessarily make a trend or that the Fed has got inflation under control, in which case you might have to have continued rate hiking, which does put the squeeze on the economy, does put the squeeze on risk assets in the months ahead, does sort of confirm what Michael Burry's talking about, how this is just one of likely many bear market rallies, as you've seen in prior bear market collapses where the markets have dropped 50%. And so you think about it, well, wait a second, you have historical data saying, yeah, it's not very probable that this turns out favorably. You look at, Michael Burry talking about, wait a second, folks, average bear market rally is a little over 20%. That's exactly what just happened with the NASDAQ. Sure, maybe it can go up to plus 40% from its lows, but still, what are the odds that you're really playing for here? Are you really thinking that the market is able to make new highs from here? I personally look at this and say, this makes me skeptical. I'm more of the camp that we will see new lows before we see new highs with this market cycle, especially given the point that, look, inflation still really isn't under control. That, yes, the most recent data is favorable and the expectations do look favorable, but the Federal Reserve still is going to be putting their screws, raising rates slightly. Now, it might be slower than previously, so we'll see. But I'm also saying, hey, I will buy things, and I called out something I recently bought to Unrivaled Investing subscribers. I'll write a more detailed, write-up later this month, where I will buy things if I find them to be compelling or intriguing, and then consider like, hey, what's the right price, and how much do I want to allocate to my portfolio based on, is this valuation, is the upside potential compelling? And so that's, that really comes down to individual stock selection. So it is important to be mindful of what Michael Burry's saying here, saying, hey, winter is coming or winter's coming, but overlay it with your own investment selection, saying, hey, if I believe winter is coming, or if I believe there's potentially a further darkness in let's say the market where this is just a bear market rally and it continues its path downward, will I be happy with the things I've bought and the prices I've paid? Do the valuations make sense? Will this company perform well even in a recession? Will I be able to hold this stock even in a recession? Or will I be a potential forced seller, which is something you definitely want to avoid? If you enjoyed this video, please make a point of hitting that thumbs up, hit that like button, and thank you for watching Unrivaled Investing.